Hello, thank you for listening in today. My name is Will Fulton. I'm manager of UK Commercial Property REIT Limited. We are one of the largest diversified UK real estate REITs with a portfolio of around £1.3 billion. Now, I think at the moment it's a really exciting point in the market for me as a manager of real estate, but also I feel for shareholders in looking at the market. We've been through, at the end of last year, one of the sharpest decelerations in value that I've experienced, and the MSCI, who measure the UK real estate market, have shown, with quite sharp falls in commercial property values triggered by rising interest rates. As interest rates and pressure for interest rates, expectation of rises came through, investors requiring greater returns, and that led to a re-rating of the market. So we've had that move in value, but in Q1 this year, our portfolio has mildly grown by around 1%, but that shows me a stabilisation of the market. And when I combine that, and I'll come on to speak for a minute about the structure of the portfolio, I think that combination of a fall in value, the fact that our company has operated very strongly, tenants want our space. We have 98% occupancy, 99% rent collection, really strong rental growth. Our earnings increased by 19% over 2022. Combining that with the value shift and the fact that we're trading at the moment at around a 33% discount to NAV and offering a 6.3% dividend yield, I think creates a really interesting opportunity. So I mentioned that I felt our portfolio was really well structured in terms of its ability to grow earnings, which is our number one focus in the company at the moment, earnings growth. 60% of our investments are in the industrial and logistics sectors, and a lot of the money is around a combination of industrial estates and big sheds in and around London and the southeast. There's such a shortage of land for people to build new property, combined with the continuing effects of e-tailing as people continue to buy strongly online. And more recently, we're seeing some onshoring as supply chains and companies are looking to create shorter supply chains given troubles around the world, and the UK and particularly big conurbations are becoming a benefit of that. So we've seen really strong rental growth with more to come in that sector. So outside industrial and logistics, we have exposure to retail, offices and alternatives, but each of those are mild exposures, and each are actually very different. In retail, I've focused our exposure to the largely to retail parks, the discount end of the market. So tenants paying low rents, making a profit, really popular with shoppers at the moment. Trafford Retail Park in Manchester is an example, and I'll come on to what we've been doing there recently. In offices is probably one of the hardest areas of the market, both to invest in and to call. A real risk that many offices across the country will become stranded, and there's a double impact coming. There's a change in, as we all I'm sure know, people's habits and working. Agile working, I think, is here to stay. People are coming into the office less. The sort of 5 day a week, 8 to 5 or 8 to 6 working environment has gone. And so there's this double whammy of less demand for office space, but also a stick of government regulation coming into play with environmental legislation requiring each property, including offices, to be a minimum of an EPC C rating. EPC, much in the same way as buying a TV or a fridge, is an A to F rating system. Properties by 2027 have to be C rated, and the vast majority of offices in the country are not at the moment. So we have 4 offices with a plan for every one of them to meet both tenant demand or do something else with them. Low exposure to that office sector. Moving on to alternatives. I'm growing our exposure here, and we're actually literally building out an exposure to beds at the moment. And by that I mean student and hotels. We've recently completed 2 great investments, one in Exeter, one in Edinburgh, really popular with students. And we're completing the development of a Hyatt hotel coming on stream in Leeds in summer. So moving away from the leisure element of alternative property investment and into beds, student and hotels, which we see as very resilient and a sector for earnings growth as well. I find it's very easy to talk in general terms, but I thought it'd be more interesting just to have a quick look at two really exciting assets that we have. They're quite different. One is Ventura Park at Radlett. It's our largest industrial holding on the M25, it's north of London. And it's a mix of 13 units, different sizes, and again, a mix of occupiers in there. Land very, very scarce, and we're seeing great demand for what is actually quite good value space as people move out of London. Recently in January, we leased 2 units, one to an aircraft maintenance firm and one to a film and media company. So again, very different kinds of tenants, but collectively they paid 60% more rent than the previous tenants had signed up to 2 years previously. We had an almost zero gap in letting them. So it shows again the demand for well-positioned space, value space in the right place from a myriad of different occupiers. So Radlett really exciting for us for earnings and rental growth, and more of that to come. The other example that I find really interesting is at Trafford Retail Park, just to the west of the M60, very close to the Trafford Centre. If anyone listening has been to, really busy part of the world. But Trafford acts in 2 different ways. Part of it is, interestingly, an informal service station. Everyone piling up the M60, coming off the junction very close to the retail park and into 4 food outlets that we have. We've just signed a lease renewal with Kentucky Fried Chicken, who again have paid around a 40% increase on the rent they'd been paying before. Really busy as a spot and a great location for doing that. The other part of the park is more traditional retail park with tenants like TK Maxx, Pets at Home, Dunelm, all again really popular from the local suburban environment of that area of Manchester. And that combination just works really well to keep rent growing. And remember that 98% of our portfolio statistic of occupied space, 99% rent collection, Trafford playing a big part and adding to yield there. Turning to outlook, I think it's a really interesting time for UK commercial property. We've been through this period of rapid price correction, and my experience in the market is that investors wanting to buy direct real estate, to buy the buildings they want in the sectors they want, are not finding the volume of stock that they thought they would, and so that's putting a bit of upward pressure for the right product on prices. Now, fortunately, and by plan, UKCM, we're invested in those right sectors, which can be probably summed up as sheds, beds, and discount retail, so industrial and logistics, the discount retail parks, and student and hotel accommodation. I think the prognosis for those sectors is good. The occupational market, my experience, is good and strong in many areas. So I think that's positive. I think some parts of the market, particularly concerned about much of the office market, where probably the majority of UK office stock is not going to meet 2027 environmental EPC regulation at the moment, and will need a lot of investment spent on it, which won't, I don't think, give a good return, combined with changing working habits. That's difficult. We have very little exposure to that sector, which is again a positive. So good occupational demand, a real focus on earnings growth for us, which we've been delivering. And then I think that gets even more interesting. At the moment, we're sitting on highest interest rates we've all seen for a very long time at 4.5% base. Our projection is that rates will come down at the end of the year. Difficult to say exactly to what level, but at the end of this year into next, lowering interest rates. So that again enhances the margin that an investor can get on risk-free investment and creates even more interest in the UK sector. So that combination of a 33% discount UKCM is trading on at the moment, 6.3% dividend yield, an expectation that interest rates will fall towards the end of the year, and a great portfolio split makes it quite an interesting time to be looking at the sector. Thank you.